Hey everyone, let's dive right into this explainer and unpack the chaotic, multi-trillion-dollar household budget of Uncle Sam's Money Machine. You know, when you hear about the national debt or the strength of the US dollar on the news, it's usually wrapped up in a ton of heavy jargon. But today, we're going to strip all of that away. We're looking strictly at the mechanics of how this massive system actually functions, who is really pulling the levers, and what it truly means for the global economy. So, let's get into it. If you want to understand the US economy, you've kind of got to picture it like a household budget, but on a scale that's just almost impossible to wrap your head around. Imagine a situation where the right hand is constantly borrowing from the left hand just to make ends meet, while down in the basement, a printing press is quietly turning out new cash just to keep the lights on. Managing this absolute circus of printing, taxing, and borrowing, well, it's a highly delicate double act between two very powerful and very distinct entities. Section 1. The mechanics breakdown. Treasury versus the Fed. So, on one side, you've got the U.S. Department of the Treasury. Honestly, think of the Treasury as the overworked accountant of this household. Their job is to collect taxes, pay the federal bills, and fundamentally, they panic when the spending inevitably exceeds the revenue coming in. To cover that difference, they issue official paper IOUs. Now, on the flip side, you have the Federal Reserve. The Fed is completely independent. They act almost like an elusive roommate standing by the thermostat. They don't collect a single dollar in taxes. Instead, they tweak benchmark interest rates and manage the money supply to control the overall economic climate. Basically, they cool things down or heat things up without ever touching a tax form. Now, when that overworked accountant, the Treasury, runs short on cash, they issue what we call a Treasury bond. But what is that really? Well, a Treasury bond is essentially a legally binding promise. It's a pretty simple transaction where you lend the government cash today, and Uncle Sam promises to pay you back in full down the road. And as a token of appreciation for helping them out of a jam, they toss in regular interest payments along the way. Sounds like a great deal, right? And it is, which is exactly why they're so incredibly popular. Section 2. The trillion-dollar credit card.
The cost of borrowing.
$1 trillion. That's a 1 with 12 zeros. The U.S. government now shells out around $1 trillion every single year just to cover its net interest payments on its massive debt pile. Let that sink in for a second. This isn't paying down the principal of the debt, you guys. This is literally just the interest. It's basically the minimum payment on Uncle Sam's metaphorical credit card just to keep the accounts in good standing. To put that colossal number into perspective, check this out. In a bizarre twist of national accounting, America currently spends far more on its credit card interest every year than it spends on its entire national defense budget. I mean, when you consider the sheer size and global footprint of the U.S. military, realizing that the cost of simply servicing past borrowing is actually a larger line item, well, it paints a pretty vivid picture of the financial reality the Treasury is dealing with right now. Section 3. Who actually owns the debt? Myth versus reality. So who exactly is cashing all of those interest checks? You know, when people picture who owns America's massive debt, they usually envision secretive foreign powers holding all the leverage, just waiting to pull the rug out. But breaking down this $40 trillion pie reveals a pretty fascinating truth. Over 70% of the total debt is actually held domestically. It's not sitting in a vault overseas. The vast majority of those treasury bonds are woven directly into the fabric of the American financial system itself. Let's look at how this breaks down. The absolute most crucial point here is that this giant 50% chunk belongs directly to the domestic private sector. We're talking about everyday American pension funds relying on these bonds for stable returns. We're talking about commercial banks holding them as safe reserves, mutual funds that might literally be in their own retirement portfolio, and individual citizens who physically hold savings bonds. This debt is quite literally the bedrock of everyday American wealth. And then we have another 20% slice that's classified as intragovernmental debt. This literally means the government just owes money to itself. It's kind of funny to think about, but agencies like the Social Security Trust Fund sometimes have surplus cash, and instead of letting it sit idle, they lend it to the Treasury. So it's simply moving cash from the left pocket of the government's trousers right into the right pocket. Now, it is true that foreign countries do hold a significant 30% of the IOUs. Countries like Japan, the United Kingdom, and China are major holders. But looking at the whole picture, it becomes incredibly clear that while 30% is definitely a large number, they absolutely do not hold all the leverage. At the end of the day, the system is fundamentally anchored domestically. Section 4. The doomsday scenario, the apocalyptic default. Which brings us to a really fascinating hypothetical. Every now and then you might hear pundits or politicians float the idea of just walking away from the debt. But the results of unilaterally wiping the slate clean, it would be an immediate apocalyptic disaster, primarily for everyday people. Because as we saw, over 70% of the debt is held domestically, canceling it wouldn't hurt foreign enemies so much as it would trigger a rapid chain reaction of total domestic ruin. You would instantly evaporate the retirement savings, the bank reserves, and the 401k portfolios of millions of ordinary Americans. And if blowing up domestic wealth wasn't enough, it would then ignite a global banking crisis. Treasury bonds are treated as the world's primary risk-free asset. Destroying them would pull the foundation straight out from under the entire global financial system. Furthermore, beyond the pure financial devastation, defaulting would simultaneously break the supreme law of the land. The U.S. Constitution explicitly states in the 14th Amendment that the validity of the public debt of the United States shall not be questioned. So the system is legally, as well as financially, designed to make defaulting virtually impossible without burning down the entire house. Section 5. Threats to dollar dominance. Losing the crown. So if a deliberate default isn't the primary risk here, what actually is? Well, it's vital to recognize that the absolute dominance of the US dollar on the world stage isn't guaranteed by some sort of divine right. It's a status that is earned and maintained by global trust in American financial markets, property rights, and legal stability. For the dollar to finally fall, that fundamental global trust would have to be completely shattered by severe, long-term fiscal mismanagement. So how exactly could that trust unravel? Consider these potential triggers. If the government triggered persistent hyperinflation, the classic scenario where a single loaf of bread costs a wheelbarrow full of $100 bills, foreign central banks would abandon the greenback overnight in search of safer harbors. Or consider aggressive international banking sanctions. Weaponizing the dollar too aggressively can actually backfire by forcing other nations to build alternative financial clubs and payment networks to just completely bypass the US system. Finally, if American institutions and market transparency simply deteriorate over time, international investors are going to decide that stashing their wealth in competing foreign currency unions or tangible assets is just far safer. Ultimately, it all comes back to trust. The intricate dance between the Treasury and the Fed, the issuance of trillions of dollars in bonds, the heavy domestic reliance on this debt, it is all one massive machine powered entirely by confidence. And that leaves us pondering a very provocative final thought. If American market transparency deteriorates and that global trust finally shatters, what happens to the world's financial system when the American money machine simply stops working? It's a critical question that every investor and truly every citizen should be keeping a very close eye on.